Welcome back, everyone, to the Noob Selling Options channel. Listen, I am absolutely thrilled to have you here today for a highly anticipated explainer. We're going to unpack the phenomenal results of the brand new investment philosophy we launched just a few months ago on June 22nd, 2026. If you've been following our journey, you know we completely tore down how we approach the market, moving away from those old conventional methods and adopting something totally different. And Today, we're breaking down exactly how it's performing and the mechanics making the whole shebang possible. Okay, let's just dive right into this staggering number. 25.55%. That is our cumulative money-weighted return. But wait, here's the crazy part. That isn't an annualized figure, and it's certainly not over a 5-year bull run. We pulled off this massive return in a mere 7-week window between late June and mid-August of 2026. Just think about that for a second. It's a level of performance that completely shatters the way most retail investors are operating today. And here's the hard proof of our net asset value progression. We kicked off the period with a beginning NAV of just over 168,000 Singapore dollars. By August 13th, we crossed the 200K milestone, ending the period at over $205,400. That's a net gain of $37,233. But actually, the most mind-blowing part is the bottom section there under deposits and withdrawals. This massive portfolio growth happened despite a net cash outflow. We actually pulled out $8,888, while only depositing $5,000. So we captured over 37 grand in growth while experiencing a net withdrawal of almost $3,900. The portfolio is literally feeding itself. Now, just look at how our explosive blue portfolio line completely dominates. Compare that to the flat green line of the S&P 500, which barely hovered between 0 and 2%, and the yellow line of the Nasdaq 100, which was actually negative for a big chunk of this period. We generated massive alpha while the major indices were practically asleep. So, you're probably wondering, how did we do this? How on earth are we hitting these numbers in a sideways market? Well, before I reveal the secret architecture behind all this, do me a huge favor. Hit that like button and subscribe to the channel so you never miss these updates. Done? Awesome. Let's look under the hood. Section 1. The architecture, engine, and fortress. So to make this work, we really have to stop relying purely on our active job salaries to dollar cost average. The core goal of this architecture is to build a portfolio that actively manufactures its own cash flow. It creates this self-sustaining loop that relentlessly buys up high-conviction assets, whether you add fresh external capital from your day job or not. Visually, it's pretty simple. We split our capital into 2 synchronized parts. The vast majority, about 75%, is what we call the fortress. This is our rock-solid buy-and-hold foundation of mega-cap compounders. But the real magic happens in that remaining 25% slice, the engine. This is our highly active trading sleeve where we use cash-secured puts and covered calls to generate synthetic cash flow. The engine manufactures the premium, and we instantly use that premium to buy more bricks for the fortress. Moving on to Section 2, the edge of theta decay. How exactly does our active engine pull money out of the market week after week? Well, our literal edge is something called implied volatility variance premium. In plain English, options are systematically overpriced roughly 70 to 80% of the time. The market's fear, its implied volatility, is almost always higher than what actually happens in reality. By selling short-dated options, we're basically stepping in to act as the insurer, collecting that spread as pure profit. And because we stick to short-dated expirations, we're talking 7 to 30 days to capture that rapid theta decay, we keep our capital incredibly nimble. We totally sidestep those long-term, scary macroeconomic regime shifts. And this brings us to what I honestly consider to be our superpower, the ratchet effect. Think about your standard buy-and-hold portfolio for a second. When the market trades sideways for months in a choppy channel, those ordinary portfolios just stagnate, zero capital growth. But for us, sideways markets are peak income windows. Even if the underlying stock goes absolutely nowhere for 6 months, our engine is churning out relentless cash flow. We use that cash to lower our effective cost basis and buy more fractional shares at baseline prices. We are constantly ratcheting up our asset base, while everyone else is just sitting around waiting for a bull run. Let's walk through the actual mechanics of how this plays out in real life using our no bad outcome wheel framework. There are really only 3 scenarios. Scenario 1, the stock rises or stays flat. Beautiful. We keep 100% of the option premium and immediately reinvest it. Scenario 2, the stock drops and we get assigned on our cash-secured put. Also beautiful. We just acquired high-conviction shares at a massive discount below the market price. Scenario 3. The stock rallies past our covered call strike. The shares get called away at a predetermined profit, and our capital is fully liberated to write new puts or buy other underpriced tech assets. Cash is flowing into our pockets in literally every single market direction. Which brings us to Section 3. Beating traditional DCA. Is this self-funding model actually better than passively dumping your paycheck into an index fund every month? Let's compare them across 4 key metrics. Look at the capital source. Traditional DCA relies entirely on your external salary. Our model uses an internal engine plus your savings. During downside volatility, passive investors just have to grit their teeth and suffer the drawdown, whereas we have an income buffer from our captured premiums. But the most important thing to look at here is flat market periods. Like we just talked about, traditional DCA yields 0% dead capital when the market chops sideways. Our active collateral, on the other hand, generates a 15 to 30% annualized yield. The velocity of our money is just off the charts because our collateral is constantly working for us, generating yield while we wait for our entry or exit points. Finally, let's hit Section 4, Golden Rules for Success. Now, to generate these massive returns without blowing up your account, you need extreme discipline. Here are the 4 critical execution principles you absolutely must enforce. Number 1, only sell puts on assets you genuinely want to own for 5+ years. Never ever sell premium on speculative, meme stocks just because the implied volatility looks juicy. If you get assigned, you need to be perfectly happy holding it forever. Number 2, sell 0.15 to 0.30 out of the money deltas. This gives you a high probability of success and keeps unwanted assignments at bay. Number 3, ring-fence your core holdings. Keep the fortress completely isolated from the engine so your long-term compounding assets aren't accidentally called away during a massive breakout. And number 4, the absolute non-negotiable discipline of reinvestment. Every single dollar of premium must strictly flow right back into expanding your asset base to feed that compounding flywheel. So I want to leave you with a question today, and I want you to really think about it. Are you ready to stop relying solely on your salary to build true wealth? The benchmark-crushing results are right there in front of us. The architectural framework is solid. It is time to step up and become a disciplined asset accumulator. If you found this explainer valuable and you want to learn exactly how to implement these strategies step by step, give this a huge thumbs up. Hit that subscribe button and join our incredible noob selling options community. Let's build that self-funding portfolio together. See you in the next one.